Good evening, everyone, and welcome to tonight's roundtable event. There's various of you coming into the room at the moment now. I can see the numbers ticking up as our administrator, Vanessa, gets us all organised and gets us all into the same place. Thanks very much for joining us. You'll see at the bottom of your Zoom pages, there is a chat box. Testing out if you can find that chat box. How is the weather where you are? It's nice and sunny here, but do you want to let us know how things are? Mark, what's it like where you are?
Oh, it's absolutely beautifully sunny here, but when last time we did this, we had somebody from, I think it was somebody from Ghana, from Accra, saying it was raining, and somebody from India saying, yeah, it's raining too. Yeah, actually, they couldn't see outside because it was dark, but never mind. So let's see if anybody can beat that. Very sunny in Shropshire.
I think it's strongly divided across the country at the moment, because we've got a gorgeous evening in Northumberland going on there from Marcus, who I think is up there for a family wedding. But Paul in Manchester is saying it's cloudy. Come on, chaps, we need to clear those dark clouds out of the way, and we'll get that sunshine through. I'm sure we can share it. Andrew, I can see it's sunny in Cambridgeshire. Beautiful county.
I've got to say, Lloyd makes me smile, Jim. Yeah, beautiful in London. We'll be firing up the barbecue right after this webinar.
Well, I'm surprised you can't multitask and do both at the same time, but that's because you're going to be listening to Alexander and Holly sharing their experiences, so we couldn't let the sizzle of sausages get in the way of that, could we? So how are we doing on numbers? We're moving upwards there. We had a lot of people who were committed to coming. I hope we don't get many dropping out, but we're certainly getting to that quorate stage. Kieran is, weather's just okay in Northern Ireland. That's from the wonderful Southwest College. Sorry, I'm a very partisan, major fan of Southwest College. And all that they do over there in Northern Ireland. Who else have we got? Sunny in Bedfordshire, excellent. And St Albans over the Roman ruins, no doubt. Cloudy in Glasgow. Oh dear, we can't have that. We need some of that breaking through the cloud coming soon. So yeah, the numbers are coming up a little bit further, so that's good. We're going to be starting very shortly. Oh, Eva, great to have you with us. It's summer in Budapest. Excellent. I do approve. Beautiful country, beautiful sunshine, I'm sure. Thank you. So, Mark, shall I
would kick off
to get in, and then we can see if a few more people want to join us in due course. So, good evening, everyone. Welcome this evening to the first of our 7 roundtables on demystifying social finance and social investment. My name's Jim Clifford, and I'm going to be chairing tonight's discussion. I'm just listening in the background to see if the dogs are going to come crashing in on me in one of those great Zoom moments, which just dissolves everything into total chaos. Around the turn of the year, Routledge published the book that Mark and I wrote with the support of the Worshipful Company of Management Consultants, Bayes, formerly Cass Business School, Alexander Hoare, who's here tonight, and a host of other contributors from across the sector. Why social finance and social investment? Well, they're really important. They're really important to social delivery as a mindset and approach, as a resource, and as an engagement between those wanting to invest for good and those able to deliver it. And right the way across the board, when Mark and I started out exploring this area, it certainly needed demystifying. So that's what we set out to do. As we push to come out of the pandemic, Mark and I suspect many of you besides, are having conversations with charities, social enterprises, funders, investors, and others, asking about social finance and investment. How, what, why, can we, should we, why not? I'll just give you a couple of key points to get your juices going from those conversations before I ask the panel for their perspectives. We're then going to go into a quick poll to get some of your thoughts on the back of hearing Holly, Alex, and Mark talk about how they see it before putting your questions to the panel and listening to their conversations. Now, when we get on to the questions time, in fact, in advance of that, if you look at the bottom of your screens, you'll see a sign helpfully marked Q&A for questions and answers. So if you'd like to post your questions in there, Marcus is going to be collecting those and feeding them to me to chair the discussion. The chat box, do please use it, but can you use it for comments on what's going on, and the Q&A for the questions, so that we can quickly find your questions and not miss some of the interesting and juicy ones. So Q&A for questions, chat for comments. So just a couple of quick thoughts then that are coming out of those discussions. Social investment, we're hearing that it needs to be distinguished from other investment. And how is it distinguished? Well, it is purposive, it is deliberate, it's actively pursuing positive social change. It's not enough just to be not causing very much damage considering. And secondly, social investment doesn't have to have little or no yield. We heard that a bit about that probably 5 years ago, maybe a bit longer. Doesn't have to have little or no yield, and it can exist within and adjacent to the mainstream investment markets. A couple of quick thoughts just to get your ideas going. And I'd then like to go straight into introducing our panelists for tonight, who are each going to do 5, maybe 7 minutes of their own particular thoughts about our question for tonight. What is social investment now, and what does the landscape look like? Nice wide question to give plenty of opportunity for different ideas. So we're going to be led off by Alexander Hoare from the Golden Bottle Trust. Many of you will know Alex and the Trust, and co-founder of Snowball Social Investment Fund. Alex.
Good evening, everyone, and thank you, Jim and Mark, for inviting me here tonight. I do act personally in my own donor advised fund, but my main activity is in the Golden Bottle Trust, which is the charitable vehicle of the partners of Hall's Bank. And in 2010, I returned from a sabbatical. My partner said, well, what are you going to do? And I said, well, I fancy having a shot at social investment. And to my surprise, they called my bluff and they said, well, okay, take 20% of the Golden Bottle Trust and see what you can do. So it began. And what I would say is that the landscape then was very simple, but nobody knew what social investment was. Now I think everyone knows what social investment is, but the landscape is very complicated. I began with a couple of sort of equity stakes. One failed, one didn't. Went into funds, which are a bit safer. So at that time, you could invest in Bridges Ventures, you could invest in Big Issue Invest. Resonance were a new kid on the block, but you could invest in it. And actually, the second investment we made was the world's first social impact bond, the Peterborough Prison bond. And it's worth just reflecting on that, I think. At the end of the day, we got all of our money back, and I think it was a 3% per annum return. Quite importantly, I'd say loads of people who would have gone back to prison normally didn't go back to prison because they had excellent care from the social sector around them. And from the point of view of the investors, it's like 103% better than just giving the money away. So it's a fantastic outcome all around, and Bridges now kind of dominating that market. So point one is, judging from my experience, there's nothing to stop anyone just doing it. That's exactly what I did. But I think you should know that there are a few problems which I've encountered just doing it. First, unit sizes can be a problem. So my unit size was £100,000 per investment, and that didn't get me into some of the investments I wanted to get into. You needed more money. Managing drawdowns and redemptions in private equity type funds is a headache. Portfolio construction needs a lot of care if you're not going to expose yourself to undue risks. And time consuming, and direct due diligence, if you're going to do it, is very time consuming. So after 5 years of that, we created Project Snowball. Project Snowball was a merger, really, of our portfolio and James Perry's family's portfolio, Panapur. And very quickly afterwards, we were joined by Friends Provident Foundation and 3 other family corpuses in a limited liability partnership. And the reason for doing that is, with the 6 of us combined, we could employ professional staff and unburden a lot of the admin from ourselves. And we did it as a partnership, so it was unregulated, which was good at the time. But the flip side of that was it was burdensome for the partners. They had to be there, all the decision making. And last year, we converted to a conventional regulated fund structure. And we're finding that's a lot easier to grow. And we give investors access to a mature and balanced, very low risk portfolio. So my second point is, well, the first point is you can do it yourself. My second point is that a fund is actually a much less work intensive and less risky way to invest in social investments, if that's what you want to do. What we have found is that any and all the United Nations Social Development Goals can be invested into. You can earn a respectable return doing so. There is a row going on about whether you sacrifice returns to invest for impact. I think it's a fairly sterile discussion. And I think even in the most aggressive financial first portfolio, if you can find uncorrelated low risk returns, you should put them in, because you can improve the risk return characteristics of your financial first portfolio. And if you're a charity like we were, you know, why would you not be investing in good impacts? So I'm going to stop there. There's lots more I can say, but I'm interested to hear what the interest of the audience is and what other people have to say.
Thank you very much, Alex. Without further ado, then, I would ask Holly Piper, Investment Director at Fairfield Finance, formerly Head of CAF Venturesome and Treasurer of Yes Futures, an education charity, for your comments.
Thanks. Good evening, everyone. Thank you, Jim. I always put the Yes Futures moniker in there as well, because it's a growing social enterprise which has taken on social investment, which means I get the experience of both sides of the fence. So both making social investments and also being the kind of the subject of lots of due diligence. So I think that's it's helpful to have both perspectives. But hi, everyone. It's well, lovely to be talking to you all. Hopefully distracting enough away from the beautiful sunshine outside. So when Jim asked me to kind of talk about kind of, you know, what's social investment now, but what does the landscape look like? I actually kind of really want to touch on a few thoughts on how social investment has been impacted by COVID. So what's happened over the last 15 months and what that means kind of going forwards. And I guess a few thoughts just to kind of start with. One is that the comparative roles of social investment and commercial bank finance for social organisations, I think, has shifted. So before COVID, social investment was usually intended to take often a higher risk than bank finance, not always, but often, backing innovation, which includes accepting some failure, focusing kind of on the impact. Sometimes social investment, again, not always, but particularly when it's foundations or family offices investing, in my experience, we're more patient, so more likely to make an investment for 6+ years rather than, say, kind of 3 years of, say, a bank loan, with the exception of kind of mortgages. So there were definitely some differences there. But actually, at the onset of COVID, the government action to support businesses, including kind of charities and the kind of social enterprises, to support their financing, which in my view has been hugely positive for the short-term funding of the sector, those government actions have consequences. And whilst a lot of the short-term consequences are really positive, I think some of the longer-term consequences kind of, worthy of kind of further discussion. So in terms of kind of the government financing, for those less involved in the kind of detail of this, that's everything from the British bank loans, so they're bounce back loans, about 50k, available to almost every organisation through their main bank, which meant that lots of charities and social enterprises, some for the first time, were taking on debt to support their cash flow kind of during the pandemic. And then at the larger end of the scale, you've got the Coronavirus Business Interruption Loan Scheme, so the kind of CBILS, which actually is much larger sums of money. And for the social sector, a lot of that money came through the RRLF, managed by the social investment business, with lots of money from Big Society Capital. And that's kind of providing loans which are much more risky for the funder without the government guarantee, but much therefore less risky because that guarantee was in place, which meant actually loans of up to about 1.5 million to lots of charities and kind of social enterprises. And whilst that's kind of incredibly helpful, that's a huge influx of capital into the sector kind of during this time. And kind of one of the kind of consequences I'm kind of really interested in is what happens next. So a lot of these organizations are now thinking about, how do we start to repay this finance? Is that kind of, for some of them, as the interest rate tips up, that's potentially an opportunity for social investors. At the same time, other organizations might be used to kind of, taking on debt for the first time. So actually kind of, there's possibly more opportunity for social investors there. But there's also the kind of the risk and the pricing expectations have been set at a really, really low level. So if you're a charity who's taken on a kind of CBILS loan, you're used to paying quite a low amount of interest. That's your expectation, which possibly might make it more challenging for kind of social investors going forwards when you're having those conversations about kind of risk and return. Saying that, some really positive consequences, I think, kind of coming out of COVID for the social investment sector. So my experience that social investors have been hugely collaborative and really engaged in finding kind of innovative solutions to how to really support as much of the social sector as possible to have impact through this really challenging time. And I think I'm really hoping, and there's a lot of evidence that's happening, that kind of spirit of kind of collaboration and innovation is kind of continuing. But again, that has implications on kind of how social investors kind of might behave going forwards, because there's now that expectation of collaboration, which, whilst I think very positive, possibly has some other consequences as well. I think the other thing I just wanted to kind of touch on was, for a lot of the existing social investors, a lot of them will be really focused now on portfolio management, as they have been for the last 15 months. Charities and social enterprises have had a really, really tough time, and particularly in sectors where COVID's actually caused massive challenges. So like the arts and kind of cultural sector, for example, where very few arts organisations have run performances over the last 15 months. It's a huge impact, not just on their impact, but also on their income streams. For those fund managers, they will rightly be kind of pretty focused on the kind of portfolio management, which means their capacity to deploy new capital is possibly quite limited. So I think one of the things that I'm expecting, if I had a crystal ball, I'm expecting to see over the next year or so is actually a bit of a flux on what funds are active. So hopefully new funds coming into the market, but possibly a kind of a change in focus kind of elsewhere. And I guess the only other observation I wanted to share is, we've talked a lot about kind of investing in the social sector, but as we kind of, we'll all know, but it's worth kind of really highlighting it, different parts of the social sector have got really different risk return profiles. And so actually investing, say, in a predominantly arts portfolio over the last year and a half, probably very different returns than, say, investing in some of the social housing funds. And whilst that kind of that plethora of expectations is really helpful, it's possibly to the disadvantage of some of the kind of the more risky frontline kind of sectors, and actually talking kind of, I guess, kind of slightly more transparently about where the risks and what the impact look like, hopefully will be a helpful learning kind of coming out of the COVID experience. Jim, I've realised I've just talked, hopefully for about 5 minutes, but back to you.
I think a stream of consciousness is exactly what we're after there. Thank you, Holly. Can I then turn to Mark, Head of Nonprofit Advisory at Moore Kingston Smith, as some of you know, formerly at Cass Centre for Charity Effectiveness, which is particularly how I know him, having worked together there, and former charity sector director in several guises. Mark, would you like to comment on what is social investment now and what does the landscape look like?
Yeah, so charities come to speak to me about two things. They either come to talk to me about survival, or they come to talk to me about reimagining their organizations. And it's funny because Alexander has looked at social investment from the investor's point of view. Holly, you've given a balanced view. I'm now going to come at this from the social purpose organization side. So when I say people come to talk to me, this is in the professional work that we do. So what we're seeing is some, let's say 50% coming because they want to survive, 50% coming because they want to reimagine their work. And it's strange because what I'm looking for the whole time is this investment mindset. Yeah, because if you've got an investment mindset, you'll put money towards certain things. If you don't have an investment mindset, you won't. And this is what I'm sensing at the moment, that actually there's a number of charities who are saying, yes, we want to take on money because we want to survive. And I think social investment has a part to play in that. And then there's a large number of organizations saying, we really want to reimagine ourselves. And I think social investment is giving that opportunity. And we've got organizations coming to talk about property. We've got organizations coming to talk about social enterprise. We've got organizations coming to talk about IT infrastructure, very few of them. But we still haven't got, for example, climate change. Social enterprises or charities coming to talk about how they could use social investment to focus on climate change. I think that'll start to be a tipping point for the future. So the second thing is, after the global recession, this was 2008, 2010, people picked up the phone all the time, to me saying, I want to come and work in the nonprofit sector. I want to come and work for a charity. And I think part of that led to social investment and the growth of social investment being so powerful because people wanted to shift that needle. What I am sure about social investment with, for example, Big Issue Invest and the democratization of some of the capital around at the moment, we really are wanting to do things with a social lens. In a way before, investment was too much about money. Now you're starting to see this real balance playing through. So what do I see as the big trends? What do I see playing out? I still think that charities want donations. I still think they want fundraising because a donation is better, but I think they're starting to play for the longer term. I think they're starting to think that they've got to think longer term. And what I've really seen is the movement of, for example, strategy from 3 years or let's say 2 years out to 10-year horizons, and people starting to talk about long-term change, long-term investment within that. That's really exciting because patient capital can sit and align itself alongside that. And then the other thing that I'm starting to see is this blending. There's an understanding by such funders as SASC that they might not be able to achieve rates of return that are full market rate of return, but actually what they're going to do is give the right investment to social purpose organizations, and specifically those that want to take on, if you like, that risk at that price. And they're making that happen. And they're doing that by starting to blend capital with grant. So I think the whole market at the moment is really quite exciting. I see charities looking for the longer term. I see them starting to see that there is opportunity. I see them wanting to start up new revenue generating businesses. So potentially there's risk capital that could be put behind that. And I think social investment is something that they now, as to Alexander's point, they understand now what it is. They're now starting to explore what they're going to use it for. That's what I'm excited about.
Thank you very much, all three of you. Now we've got some questions starting to build up, which is great. Thank you very much. Please keep them coming. But let me pose a first one, which links back to something that Holly was saying, looking at some of the challenges of the time in which we're currently living and coming out of lockdown, we hope, at some stage over the next month. And I got a sense of the battering that some charities and social enterprises have suffered, but also the huge growing need that we're hearing about. So, question for all of you, how can patient investors, as Mark was describing them, react now the world has changed with COVID? Could I take Holly first on that?
Yeah, sure, happy to. So I think the first thing is carry on being patient. It was really noticeable at the beginning of the beginning of COVID. There was a lot of, I think everyone's expectation, possibly optimism bias, was expecting I think that the health crisis certainly to be over at some point last year, and therefore the recovery to be beginning last autumn. And it's now clear that that's not exactly what's happening, particularly not happening in all sectors. So I think that patience probably hasn't been fully tested yet. So I think if you set yourself up to be a patient social investor, carrying on being patient and letting your investee organizations know that you're being patient is a really, I think, a helpful thing. I would say that probably has a couple of counters to it though. One is, if you're a charity or social enterprise who's taken on investment, you have taken on to repay it. And so you do have to have some kind of plan. It might be plan D for how you might repay it. It's I think, not really good enough to be like, we're not quite sure. I think you do need to have a plan there. And as an investor, you need to have a conversation about what that plan looks like. And yeah, I think that's the main thing, just carry on being patient for me.
Alex, your thoughts? How can patient investors react now the world has changed with COVID?
Can I react to Holly as well? I think I may have been lucky. So at the beginning of the pandemic, there were these statistics flying around, and 1 out of 5 charities going to fail, things like that. What we saw in our donor advised fund, we saw our customers rallied together and shoveled £60 million out of a door in a few months. And then one of the charities we back is called The Four, and The Four itself supports small charities. And all of their beneficiaries, mainly they needed IT help to work from home, and they did it. They got some kit, invested and worked from home, and they've done fantastic work. And I'm chairman of trustees of an arts organisation. It's a youth drama charity called Intermission Youth. And the most bizarre thing is we had quite a good year last year. We were lucky. We started by not having a theatre. We'd just been evicted. But we got into film, and it's all black cast, and black issues came to the surface. So whilst there were unlucky charities, there were also lucky charities. But I agree with Holly that patient investors have got to walk with to be patient.
Okay. Mark, can you comment? And then perhaps once you've commented, would you lead us into the poll that we wanted to ask our audience?
Sure. So what I found really interesting was I was talking with one of the audit staff the other day, and what they said was that charities actually have more cash than they've had for a very, very long time. So it surprised me that they've got this level of cash, and then you're starting to think about the future, and you have to ask yourself the question, what are they holding that cash for? Are they holding that cash because actually they're going to use it in the normal course of business and it's going to go down? Are they holding it because actually it's unrestricted reserves? I'm not hearing the latter. Yeah, so I'm hearing that they're holding working capital and they're going to be spending that working capital. Well, at some point in time, that working capital is going to decrease to a level where you're going to have to start to replace it. And that's where I think that social investment will start to play in. So I think that, back to Holly's point, I think we haven't reached the patience point yet. I think we've got another 1-2 years worth of uncertainty as we play through what this looks like. And back to the 50-50, those that want to survive, will have to use everything at their disposal. Those that want to reimagine, I think, will start to look towards things like social investment, because they're looking, I said that horizon has shifted forward. They're looking forward and looking more than now 2 or 3 years. So I kind of think we haven't got to the patient bit yet, but it's just being flexible and agile. That's what funders need to be at the moment.
Thank you, Mark. Having forgotten to do the poll, mea culpa, as just before we moved into the question, I nevertheless felt that was an interesting follow-on to some of the explanations that we'd heard from our 3 panelists. So if you'll forgive me, Mark and Marcus, can you just take us through the poll to see what some of our audience think, and then we're going to tackle some more of those questions. So
Jim, we said that we wanted to have a nice relaxed evening where we actually had some conversation and we got some decent questions. So it's lovely. Vanessa, you're with the person with the poll, and Vanessa's popped up the first poll, yeah? And here's a simple question to get us started. Which of these is the most important to build social investment now? Is it the funding that really addresses the problem? Is that what we need? Is it access to funding? And that's by investees. Is it good relationships between funders and funded and the intermediaries, the wealth managers, and between them and social purpose organizations? Or is it really still the structures and instruments, the new structures and instruments? Is that what we need? Yeah. So is it funding, access, relationships, or structures? And this is the bit where we sit like countdown hosts.
We can't vote.
Yeah, but we can do the clock. We can go do. No, I'll stop that. Which one would you vote for, Alexander, then?
I think probably the last one.
Structures and instruments. And Holly, which one would you vote for?
I was going to go for the first one, but I think also we should explain to the audience that Alexander and I changed all of the questions in Mark's poll very unhelpfully at the last minute to kind of add some nuance in, which I'm looking forward to discussing.
Oh no, I think we were just developing the amazing editorial capacity of our panel, who are very talented people as a collective.
I've got to say that it was edited, but in a very kind way by both of you. So I'm going to give people literally one, let's say 30 seconds more just to vote, 30 out of 36. Yeah. So people are really engaged here. Before I close down. And then Jim, why don't you talk us through the what you can see?
Yes, certainly will.
So I've ended the polling, and access to funding by investees is the top.
Is indeed the top, although it is finely balanced. Access to funding, 33%, good relationships, 27%. Have to say that is the one that I would have gone for had I been allowed by Vanessa to do the poll. And the structures and instruments, yes, some good leadership there from Alex, thank you, sir. 27%, all finely balanced. Interestingly, the need for the funding is the lowest of the 4, 13%.
Didn't we agree they're all important?
Yeah,
they are.
But maybe Jim, that shows that actually organisations have the money they need at the moment, but it's the future that they're going to start to think about. So back to that point again. But I mean, certainly I didn't expect the access to funding. I thought it was going to be the relationships, please.
Although interesting that we were all talking about being patient, and that for me is coming through in the good relationships and presumably the structures and instruments that are able to illustrate that patience.
It's also quite heartening, to be honest, though, that that's a very investee focused answer. So it's kind of around actually what the charities and social enterprises would find most helpful for the barriers on their side. So I actually think it's very heartening that that's one of the top.
Indeed. Go on, Mark, give us another question.
I'm not quite sure how to do this, so I'm going to have to rely on somebody behind the scenes, Marcus or Vanessa, kindly just to move us to the next one. But I can press the button to stop it, Jim.
Excellent. What a good chat. There we go, as if by magic. So this is question 2, despite it saying question 1. We need an accountant in the room somewhere, Mark and Jim. Okay, go on, Mark. You read it for us.
So which of these are key to getting social investment right? Is it the governance behind it and good governance? Is it getting the risk and returns right? Is it impact measurement and reporting on that? Or is it about this due diligence piece, which we haven't really explored yet, but I have a sneaking feeling that actually will prove to be the most important. In other words, due diligence and assessing if it's right for an organization or not. So we've got governance, we've got risk and return, impact measurement, and getting the due diligence right.
Which of these are key? And I believe you can only vote for one.
And yet, Alexander and I are still, we're still been disenfranchised. It's most unfair.
So Holly, this time around, which one would you vote for then?
Governance every time, above all of the others. I think I'd much rather, I guess my experience is making an investment in an organization which has excellent board and senior team will get you through a lot of quite tricky situations. Yeah. Whereas an brilliant organization having great impact, but with a weaker team and board, you're not as well set up against what the future might look like. This is when Alexander can violently disagree with me.
No, Holly, I've just got to say that actually you increased good governance by 400% there. So as soon as you say good governance, there was 4 people who voted for it.
Go on, Alex.
So Alexander.
Just in support of what Holly said, I was talking to the chief investment officer of a very large organization. And he said to me one day, he said, you know what, all due diligence is actually a waste of time. All that really matters is the people in the organization, when the shit hits the fan, will they do the right things? But I would say getting the risk and returns right. If they're right, everything else will follow.
Isn't it funny then? Isn't it funny, Jim, then what we did was we had a pre-meeting around this, and we all said that actually the impact measurement and reporting is probably the one that is actually the least important for getting social investment right. It's important, but not as important as some of the others. And so actually the one that we thought people would vote for, they have voted for. And so I'm going to put us all on the spot then and reflect on why, if you like, people are choosing impact measurement, whereas we're talking about risk and return and getting due diligence right, and back to Holly, the good governance piece. Yeah. So there's a question for you.
Holly,
the way we talk about it at Snowball is in the past, the financial world looked at risk and return, and in the present, you should be looking at risk, return, and impact. And then you get into some quite obscure questions of how you measure and report on impact.
Yeah, so I mean, I find that answer from the poll really interesting, actually, because impact management as well as impact measurement is obviously really, really key and shouldn't be assumed that it's there. But I think I still very firmly stand by my governance, like a well-run social purpose organization, so social enterprise, needs to be a well-run business. And if it's not a well-run business, then it doesn't matter how much impact it's having today, to be perfectly honest, because if it won't be around next year, that's somewhat redundant. And I know that sounds particular. So I used to run a very active philanthropic social investment fund where impact is at the core of everything we do. But I still stick by governance being absolutely fundamental to making investments work. I've not been persuaded, in other words.
It's funny, Jim, and if I may comment, what I found from those that were working and were very much more on the social side of things, when I used to ask them as part of my research, which is the most important for you? And they would say the team, the social hurdle, the financial model, the business model. Yeah. Oh, sorry, the business model, the financial model. And then I go to Barclays, and some of the other, if you like, larger banks, and they'd say exactly the opposite. They'd say the financials, the business, the social hurdle, and then they put the team last. So I think it's part of, if you like, doing the right thing and working very closely in alignment with different, borrowers, if you like, and those that are being funded. That alignment is really important in this relationship. It's interesting, isn't it? So team comes first, and then teams comes last in the other way around.
Jonathan Ball has said in the chat about impact, you need to prove you can deliver what you say you can, or people won't invest, which is that important point that impact is a gateway, is a boundary to social investment, which I think is a point well made. Then Keith is coming in, and yeah, you've got your fan club in the chat there, Holly. Governance is indeed key.
I was going to say, Jim, do you want me to hold the poll up, or shall I kill the poll now?
Kill the poll, if you would, please. What I'd like to do, though, is in our discussion, some of the points were coming up around due diligence, and one of the questions that's been posed to us is, what skills do you need to have to carry out the due diligence? And I think this is probably looking from an investor point of perspective, but open for discussion. Alex, would you like to start us on that? What skills do you look for?
You need actually quite a lot of time, and you need experience. So with experience comes the judgment of what questions to ask. And by the way, what are you looking at when you do due diligence? Yes, you're looking at governance. You know, without the governance, you're not going to invest.
Okay, Holly.
Yeah, if I can add to that. So yeah, I mean, I've clearly stated my opinions about governance. I think on due diligence, I think it's worth thinking about the skills you need to do it. So I kind of run a social investment team, and actually we've often got people who are relatively junior in their career. So it's how do we enable them to ask the right questions, particularly when it's around governance. So I think that's kind of worth considering. I think it's also, though, due diligence is as much about the skills as it is about kind of setting out the expectations really clearly. I think when due diligence is successful, it's when you as an investor can be really clear with the social organisation what it is you're looking to find out. So it's not like a treasure hunt for like some missing treasure. It's a kind of, look, here's what we need to see, here's what we want to understand, help us to understand it. And then I think you take the conversation immediately up to much more of a discussion and much less of a kind of top-down funder to investee, because, and I think, and the reason why I think it's really important setting that conversation like at this level and that relationship at this level up front is you can do them as much due diligence as you want, you'll miss something. You'll always miss something. Sometimes it'll be the thing you really shouldn't have missed. And I think if you think about kind of your due diligence lasting, say, a few months, and then your investment lasting for kind of 6-7 years, that's 6-7 years is really, really important. So setting the relationship at the right level where they will ring you up and tell you something if something's not going wrong. And I've had kind of almost everything happen, I feel like. So fraud, various allegations of impropriety, like almost everything you can think of. You want them to tell you that. You don't want to find it out. Sorry, Jim, I went off topic again.
No, that was very good. That mixture of governance and due diligence. Alex.
In support of that, we had an investment committee today, and we decided to invest with this firm instead of the firms we were investing with, because this firm was willing to communicate with us and work with us and relate to us. So I completely agree with what she says.
So can I just say from the charities? Can I just say from charities' point of view, when we were writing the book, Jim, we talked about due diligence, and both of us agreed it was like the dark art. People didn't really know what due diligence was. They didn't really, have an understanding of it. And those that have been through it found it was much more onerous than they thought it was going to be. Yeah. So don't underestimate it. And that's why in the book, what we've really done is we've gone out of our way, and Jim, you wrote that section on due diligence to really explain what it means. And it means looking at the governance, meeting the people, looking at the team. It means really stress testing the market, looking at the future financials, looking at the impact case, stress testing, will that actually be provided or delivered or not, and the risk around that, And then the final thing is looking at the general risks of the organization and what might stop the organization from delivering the impact, and then the investee getting their money back, which they give back to the investor. So actually due diligence for me is like, it's the dark art still, and it needs to come to the light.
Thank you, Mark. I'm going to run through a few of these questions and move fairly quickly, because I'd like to get some of them in before we close, and we're targeting to finish on the hour. Question, I guess, to Holly and Alex. What is the best way to search for and find opportunities that align with specific charitable objectives?
Yeah, shall I start with this one?
Go on, and then on to Alex.
I think it depends how niche you're going, to be perfectly honest. So I think if you're an investor, there's a host of kind of people you can talk to. So if you're a foundation, for example, there's a grouping called the Social Impact Investors Group, which is part of the ACF, and that sees a lot of opportunities, and also that's a very good network. So if you're on the kind of more the philanthropic or foundation side, or that's what your capital is, even if that's not your intent with your investment, that's a good place to start. If not, there are a few kind of other networks, depending if you're a kind of family office or foundation. Frankly, if you've got money to invest, probably people, if you make yourself known, you'll probably find that people will kind of come to you. I think it's really interesting though around that how focused you are in terms of your theme. So I've worked in the past with particularly kind of with individual philanthropists who really want to, kind of work, really invest in, say, kind of children's education in a very particular part of the world. And that's fantastic. But that impact goal and that investment kind of, plan might not fit. And it certainly might not fit for a diversified approach. So I think I always encourage people to think about, if you really, really know what you want, the change you want to make happen, that's absolutely fantastic. But actually, if you're more broadly interested in kind of social purpose change, taking a broader view is quite a good way of ensuring you've also got that kind of balance of returns as well.
So think broad and ask your friends.
Yeah, exactly.
Alex, would you, your thoughts on this?
I completely agree with what Holly says, but if you've got a fund management house, it helps. And the other thing is to say is that the landscape, because there are so many specific things you might aim at, the landscape has become much more complicated than it was 10 years ago.
Just coming on to a related...
I was going to say, Jim, just on behalf of those charity people that are watching, and they're asking the question, who would I approach? Well, I would start by going to Good Finance. And Good Finance is a cracking place to actually go. It's big society capital, and they've got a lot of the information there about where you would go to find an investment. Yeah, and then once you've started with Good Finance, the whole ecosystem will suddenly blossom in front of you. And you've got the more social, if you like, investors. Your Esme Fairburns and your Tudors. And then you've got others there, including the social investment finance intermediaries, these intermediaries that have created the market. Go and talk to some of them, because they are absolutely brilliant at creating that relationship. Yeah. So Investing for Good, for example, I've noted Jeff Bernand is on the call here. And I wouldn't normally do a call out, but I'm just saying hi. Jeff. Hi, Jeff. Yeah. But I think those are two really good places to start. And theme specific investments, there are lots of them that sits within SIFIs, social investment finance intermediaries. They will help you to go and find the money around, for example, old people or health, etc.
While I've got you on the floor there, Mark, if not on the ropes, a question from Nicola of the Honorary Treasurers Forum. Firstly for you, and then I'd like to go on to Alex and then maybe Holly. Is there a moral obligation on endowed charities to make social investment and spreading more joy that way? If so, how does that square with the obligation to maximise returns?
Well, it's really interesting. Forgive me, 2 seconds. It's really interesting because how I got to meet Paul Palmer, and how I came to work for Cass Business School was exactly around that, I had a couple of drinks, and I gave Paul a call, and I said, how much of the endowment, how much of the money in the charity sector is invested in the right way? Yeah, in other words, for charitable purposes, with, if you like, a screening towards responsible investment. And he said at the time that less than 10%. And I said, what are we doing then? As a sector, we're not helping our own. Now, I don't know what the figure is now. This was 15 years ago. But I fundamentally believe there's that obligation. It's interesting though, isn't it? So, Nicola, because you've got to make a financial return, and you can't just give away all of your money. I mean, the whole point of having a portfolio and having an investment portfolio is you make a market rate of return, in some, and some you don't, and some you actually make over the market rate of return, and that balances the portfolio out. So it's a really interesting question, and getting the money right and using your head and heart to if you like, sort of manage a portfolio on behalf of, for example, the charitable investors. I think it's a real skill, yeah. But I do think there's a moral obligation to provide. That's just my personal view.
Alex, what's your thoughts on this?
Yeah, I think there is a moral obligation. If you turn the question around and say, should charities invest in weapon manufacture of cigarettes and gambling, the answer is quite clearly no. So, and I think there's a movement. So we, the Golden Ball Trust, have gone 100% invested for impact now. We've not had any problem with the Charity Commission. The Charity Commission has been quite helpful. There are question marks around the inland revenue. So they're less helpful, and you could, if you upset them, lose your charitable status. But I've never seen that happen. And more and more people are going portfolio impact.
Okay. Holly, any thoughts to add?
I mean, I think I'd agree with that. I probably wouldn't describe it as a moral obligation. I think the one thing I would add is I do think there's an obligation on endowed charities to ensure their money is kind of, you know, invested reputably and for ideally positively intended impact. I think there's a massive spectrum here that we're talking around, and actually, if their risk profile is really, really low, some of the investments we've talked about won't necessarily be suitable for them. So I think there's probably a broader spectrum that perhaps we're talking about here that are kind of worthy of kind of consideration. I guess the only other thing is telling charities that they have to do something in a particular way doesn't always lead to massive success. So probably a bit more of a nudge approach is appropriate.
Okay, I've taken it in a slightly different direction, but if I may, question here from Sandy Look, who is from the Marine Conservation Society. If you're an environmental charity and you'd like to start thinking about environmental impact investment, where do you start? Where do you get some initial advice to develop ideas, and what might those ideas be?
There's a thing called the Environmental Funders Network. That would be a good place to start.
Tell us more. Tell us more, Alex.
I've never been actually, so I can't.
Okay.
I know we use it. So we specifically were looking to do environmental projects this year, and they pointed us in the direction of peatland restoration, and yeah, they were helpful.
Okay. Holly, have you any insight on this?
I'd say that was exactly the right place to start. There are a few foundations doing some really interesting work in this way. I guess the only thing I'd start with is know what impact it is you want to achieve, not what the investment is that you want. So start with the impact and kind of work backwards. But yeah, I'd echo Alex's recommendation.
Mark?
I was just going to say, I'm not sure, but gin is the place that I'd start. You know, gin typically has some good case studies and links into the type of organizations globally you'd start to think around that. That's
the Global Impact Investor Network.
Sorry, Global Impact Investment.
Yeah. Okay. Thank you. Thank you for that. Sorry, I'm just sifting through the questions to try and see what we've got time for in the last few minutes. Coming back to, we've got a question around how do charities in the global south generate sufficient income to repay social investment and to pay the yield on it. So I would take that slightly broader to a question about charities that have relatively low income budgets compared to the cost of capital and maybe the capital that they need. How do they generate sufficient to repay? Mark?
Forgive me for starting this one. I opened a toilet in Zambia, and it was funny.
There's a story there.
I know, the press came, and you know what I'd done was I stood there and I looked at the old toilet block, and they said that was 6 months ago that was built, and it was built from a grant. And you know, and I said, well, what's wrong? And they said people didn't respect it because it was just given to the community. And then I said, well, what's different about this? They said, well, we're going to sell condoms, we're going to sell soap, we're going to have like, you know, a shower unit that sits next to the fish market so people can clean themselves. And I was saying, you know, so how long are you expecting it to last? They said, at least 10 years. See the old one down the road there? That was 10 years old and it's in perfect condition. And what I learned is that people will spend a little amount of money to keep those in good order. And quite a lot of the charities and NGOs in the global south, or the, you know, the developing world, if you like, they, you know, the charities actually have the ideas, they just need the capital to make them work. And so when I asked, was the business model sustainable? They said, totally, and people are happy to pay for it. So I've learned with my own, if you like, sort of, you know, eyes, that it just needs the capital to bring these ideas into life.
Alex?
I'm going to pass on that question until I've reread it.
Okay.
Whilst you're passing, shall I answer? Actually, Jim,
please,
your broader question, which was like, well, what do you do if your margins aren't big enough? And in that case, I say that social investment probably isn't suitable. Like, it's not suitable for every social organisation. It's certainly not suitable for every purpose. And there are lots of instances where grant funding, not in the case of Zambian toilets, I get you, but grant funding actually is incredibly helpful. And COVID, again, has been a really good example of that. So actually the emergency grant funding that funders were able to provide has been incredibly useful. So at Federal Finance, we ran a COVID resilience fund, and we made about 4 million in grant funding to some 36 organisations. And a lot of that was around supporting those organisations to be able to get their staff working safely and effectively from home so that they could serve their customers remotely. So a lot of our grants are spent on the really unexciting things such as mobile phones and kind of broadband connection and kind of new laptops. That's not appropriate for social investment, I would say, but it's a great use of grant funding because that funding enabled those organisations to carry on. So I guess it's my plea in terms of the social investment. Don't forget the role that grant funding can play in some circumstances, and it's incredibly valuable.
It's a point very well made. I'd like to pose another question, one final question that's come up in the question bank, but which is an interesting look forward, so quite a good one to finish with. What is happening to the length of time over which social investment projects are running? Are you seeing longer projects, shorter projects, or whatever coming through at the moment? Alex?
I don't think I can answer that. Many of the funds we're investing in are 7-8 year funds.
Okay. Holly, what are you seeing? I'm personally, I've seen quite variable lengths and a number of prospects coming forward that are needing longer term 15, 18, 20 year funding. So what are you seeing?
Yeah, Jim, I agree. I mean, I think it is, there's still a real variance. I think I'd go back to one of my earlier points that almost like your existing social investments, that's where patience is really helpful. So if you're a funder, having patience for the existing time frame of your social investment is probably really is a good thing.
Mark,
I'm going to go back to the global south, where I know more about social investment than I do probably in the UK. And I'm going to say very clearly that what we're seeing is people graduating from microfinance to what I'm going to call gazelles. In other words, small, rapidly moving businesses. Now, I don't know what COVID has done to that market. It worries me, how that will have been broken down. But by the nature of investing away from microfinance and into gazelles, you're moving to a longer time period. So I see in the international spectrum, that is slowly starting to extend and much more patient capital to boot.
Yes, and with some very long established and long life endowments in the market taking social investment on, that does give the opportunity for much longer investment than the point about the standard 7-year, 5-year, 8-year funds that Alex raises.
Yeah, and excitingly, Jim, you've got people like the Stone Foundation starting to make the first, investments into, for example, water utility companies across the global south. It's exciting.
Yeah, and again, sanitation in Cambodia, one that I've looked at for them. So yes, long-standing family funds who can do this. Right, I've got quite an eye on the time. We are up against our stop time. I must say thank you ever so much to Alex, to Holly, to Mark for your views and thoughts. Thank you everyone out there who's not only listened but has contributed an interesting range of comments in the chat and also some interesting questions. I'm sorry if we didn't get to your question, but thank you very much for asking anyway. Just a quick reminder, this is one of a series of these conversations. Please come to the others. The next one is going to be on July the 20th at this same time. So we'd love to see you there. And that will be looking at the case for change, how you develop business models that fit social finance and social investment. Really important aspect. So do come and join us then, please. And last but not least, if we just flip on to the final slide there, Mark. Thank you ever so much, everyone, for joining us. Please look out for Mark and Marcus and my summary of what we've heard today. Once again, thank you so much, Alex and Holly.
Thank you.